Stocks trying to hold on to what they've got after a little dip in the session. Joining me for big picture discussion, Nate Peterson is Director of Derivatives Analysis, and Cooper Howard joins us from the fixed income team to talk some bonds. Afternoon, gentlemen. Cooper, nice little fade here in Treasuries, basically going back to last Friday.
Yeah, we've seen a little bit of a move up in yields today. I think there's a couple catalysts for that. If you look at the data that came out this morning, we obviously got initial jobless claims, continuing claims. Pretty big move up in both, Oliver. I think it's difficult to kind of see, is this a one-off or is this a sign of things to come? There is some seasonality with it. So if we think back to last week was Thanksgiving. So maybe there was a little bit of seasonality to that. Also, if you look at the PPI data, inflation doesn't appear to be trending lower as originally expected. We do think though that it'll be a bumpy road down to that 2% target. So those are kind of the reasons I think that we're seeing a move up in yields. But looking through a lot of the PPI data, the things that flow through to PCE, which is the Fed's preferred measure, as we all know, that bodes well for what the Fed is likely to do. So that shows that PCE is likely to trend lower on a year-over-year basis.
So then maybe that gives us some explanation for why yields can go up, but the Fed expectations for D's don't have to change too much. Is it kind of happening more maybe on the growth side, just kind of realizing inflation is going to come off? That should release some pressure on the economy?
You know, I think that that's a difficult thing to look at. And I think that what you're getting at is the different parts of the yield curve.
I think so,
if we look at the very short-term part of the yield curve, we do expect that, it's pretty much all but baked in that we're going to get a 25 basis point rate cut next year, or next week, excuse me. But what comes of next year? Now, my expectation is we'll continue to get rate cuts. I wouldn't be too surprised if we get about 3 rate cuts, bringing in the neutral rate comes down a little bit. So I think also what's going to be important to watch for next week is what does the Fed project going into the next year? There's also a lot of things to be on the horizon for next year that could bring yields higher, actually. If we look at trade policy, if we look at tax policy, immigration policy, a lot of the policies that the new administration have proposed or are bringing in, they have the potential to be inflationary, Oliver, and that could drive up yields going forward. So our expectation, taken all together on a longer term view, is probably that the yield curve is going to continue to steepen a little bit more, led by lower short-term yields.
Nate, do you see any of this bond chat relevant for stocks at this point? I mean, I do think chart-wise, the move is kind of meaningful here now at this point for bond yields. But stocks, I mean, they were just ripping yesterday, and it seems like they're in good condition. Should we be tying these things together?
Well, I think it depends on, of course, the velocity, but that level, if you go back to November, I believe it was around November 15th or so when we actually, kissed that 4.5% on the 10-year. And that's when we actually saw a negative 2-day reaction in the S&P 500 before 10-year began to roll back over, and then now it's starting to creep back up. So we're at 4.32. I'd keep an eye on 4.5%. Do yields matter? Absolutely. But I think the bulls are kind of in this position where, okay, inflation's sticky. The Fed's not going to cut as much as long as yields behave. And I would say yields are behaving if the 10 years between 4 and, 4.4, 4.5. I would just say stay below 4.5. And the economic data is healthy. Looking for, 12% EPS growth in Q4, 15% in 2025, and we got 3.3% on the Atlanta Fed GDP. As long as that's tracking, as long as the 10 years below 4.5, I believe the bull thesis is intact. Melt up.
All right. The melt up that we're getting is spurred IPOs. We were just talking about Service Titan. Pretty splashy response, fitting with the other signs of sentiment lately, Nate?
It is, yeah. Bitcoin above 100K. Mm-hmm. A lot of the call activity that we see. We had a record 69 million contracts. I think it was the day after the election day, and so call activities picking up, option activities picking up. A lot of these themes, some of these innovative tech themes like quantum computing, hitting the headlines in terms of Amazon, launching their quantum embark for AWS, Alphabet with their quantum chip. So we're in this period where, yes, like I was talking on Fast Market earlier this week, and I said, for first in a long time, it's kind of felt like this is a little bit like the dot-com energy, that there's so much innovation that's going on right now, coupled with a lot of this very, animal spirit-like euphoric speculative behavior that is coming back into the market, but not yet at an extreme. Feels a little bit like 2021, but not an extreme. I think it makes sense that we start to see more of these IPOs that are going to be hitting the markets, and the capital markets are expected to do well, looking at what financials have been doing.
Good stuff. Nice connection. Appreciate it, guys.